joining us. Danny Kirsch is head of options at Piper Sandler. Always got the wheels turning in his mind on how to trade, how to take advantage. I don't know, is it a crisis situation when we have to dip into tech to buy other stuff, Danny? Because the market has been kind of celebrating this rotation, but I'm not sure the math is one we want to really get behind.
Yeah, I thought everyone was upset about the lack of breadth in the market when it was initially rallying, and that was concerning. And now the concern is that there's too much breadth, and we're getting a little bit of a pullback. I know the ASML earnings look fine, not great, but not certainly not 11% down. But I get the sanctions on semis are hurting the space, and I think this all is a positioning sort of story. And it's taking longer to play out than I think people expected. But you've had multiple years or this entire year of this Q's outperformance relative to small cap. And you had a couple events that happened kind of back to back with the CPI coming in light and then some more softish data on top of this Trump sort of explosion higher into the polls and like the Republican sweep odds increasing. And it's all tying into this cyclical trade, this broadening trade. And this mispositioning, misalignment trade. And like what we're seeing is record call buying in IWM. And that tells you, one, yeah, sure, people might believe the story, but two, people were short and for good reason, right? It was a trade that basically worked almost the entire year, long Q, short IWM. If it didn't work for a day, it'd work the next day and make new highs. And this just sell-off has been fairly vicious. I'd be hesitant to get super long IWM here, especially as we approach earnings. Names like Nvidia are probably going to have really good earnings. And, while you're getting these pullbacks in the tech space, I'd think that as you get into earnings, perhaps some of this unwind, some of the shorts stops. And that would be like maybe the area to start getting long. And Nvidia's been one of those names you've been rewarded for buying the dip. We'll see if that continues to be the case. But anytime these moves have happened, and this isn't unique, this isn't the first time Nvidia sold off or been to these levels. It's happened a few times last couple of months. You've been rewarded by getting long the stock into earnings.
Yeah, the quality of earnings is definitely going to be a lot stronger, and the stuff that's getting hit hardest going into earnings, which is the tech trade. So if you're looking for justification or logic for a bounce back trade, that might be it, right? So I hear that. Taiwan Semi will basically be the first test that tomorrow to see how that goes. Just some perspective, because everybody's kind of got their go-to superlative in describing the past week. You're just looking at the 5-day return of Qs over IWM, most extreme in favor of small caps since 2002. So fair to say we're making 20-year history here.
Yeah, absolutely. So that's what this chart is just showing, the 5-day return of Qs over IWM. Again, I think this speaks to the extreme positioning in long momentum versus short momentum, long Qs versus short IWM, long quality growth versus short, I'd say more levered companies. And this positioning got so one way, again, for very good reason, but the unwind has been vicious. And I'd say, clearly surprising. Clearly, people caught off sides and shown don't have enough IWM exposure. That being said, IWM was flat this year until this recent rally. Now it's up 11%, and it just shows how fast things can happen. And oftentimes these macro events have been underpriced. And this all speaks to the VIX today is up to 14 and change. Vol is still not high, considering these massive rotations, massive moves we've had. And one thing that we look at is like the daily cost of an S&P straddle. So I think yesterday a straddle was 40 bips. I think today it was 50 bips. We moved 1.3%. These daily options have been way too cheap. And, obviously talking up our book, it's a great time to be using options for either leverage or protect gains, or again, if for the daily punter, options have been too cheap. These last few days, clearly options have been way too cheap. We're not pricing enough movement.
For the Russell, though, IWM, we moved up in vol even as the index was rallying, though, right? So a heavy speculative call skew. Is there something we can do with that? Is there a way to play options if you do want to try and bet on this?
Yeah, absolutely. Unwind? So one thing, if you were brilliant enough to catch this, your long IWM underlying stock. This is just a chart of IWM 1 month 10% out of the money call volatility. Typically, this spikes when Russell's selling off, not when it's rallying. This just shows you this almost panic cover, panic call buying, panic demand for upside in Russell. There are two things that this chart tells me. One, if you want to get long, you're not long, you want to chase it. And I don't necessarily think it's not necessarily chasing. If you want to get long IWM, it's something that still hasn't made new all-time highs where everything else has. Buy call spreads. They're cheap relative to history because those wingy calls are so expensive. Two, if you own the IWM, the underlying stock, it's a really good time to sell out of the money calls, like that 10% out of the money call, and you can fund a roughly 6% out of the money put going 1 month. So you have 10% upside, and let's say this euphoria goes away. Let's say IWM, the earnings aren't great over the next month, and you're going to get all of Russell earnings the next month. You're hedged down 6% plus. So anything below 6%, you're hedged. And that trade is even money. And again, that all speaks to this bid for upside because that's where people aren't. So callers sell call by put, or you feel like you need some IWM exposure. Think this keeps going, rates keep going lower, Trump trade keeps building, buy IWM call spreads in lieu of outright calls.
All right, nice. So love that. Always giving us a good approach here, kind of no matter how you're thinking about it, if you want to go long or short. But the bottom line is there should be options used with the amount of volatility that's just picked up.
Absolutely. And I think like earnings are going to be the test, right? Like, do these stocks show much better earnings because the Fed is going to cut rates 25 or 50 bips over the next over the next year? I think that's unlikely. I would be hesitant to get super long Russell into earnings. I think it's not a horrible idea to hedge, even swap out of some of your stock for call spreads.
Heck, if I'm a CEO, I might even just throw the kitchen sink out this quarter and kind of prep myself for what could be some macro support coming down the line if I really do think rates are going to be getting cut a bunch. So it kind of seems like there's slim reason to expect some big sudden surprise in the fundamentals. You're watching the financials too, Danny. I want to make sure to get to that because KRE, standout winner today.
Absolutely. KRE, XLF acting very well. So it's like you can take the bet on junk. You can buy or smaller cap, riskier names, or you can take a bet on something like an XLF or KRE. KRE has not made new all-time highs. It's still 20% off the pre-SVB highs. It's probably back to those levels before SVB went under. XLF at new highs, but it's been massive underperformer the last few years, especially relative to tech. And implied volatility, that's what you're showing here, is 3-month at-the-money volatility of XLF and KRE. Doesn't get much lower is the takeaway. It's very, very inexpensive on a relative basis, on a historical basis to buy calls. That's where I'd rather take a shot on upside. You just saw great earnings out of Bank of America, JP Morgan, Morgan Stanley, Goldman Sachs. The big banks just had great earnings. They're also a winner on the Trump trade. They're a winner on the curve steepening, the front end coming down, and they have earnings power. It just seems like to me like a much more safer, obvious way to play long. Perhaps there isn't as much upside as something like a Russell, but we still see a lot of upside, and the fundamentals are behind there. And if you look at IWM and KRE shares outstanding, so just looking at the ETF shares created, they're still near the lows of the last several years. So I think it's a place that's been underinvested. I think it's a place an area that you should feel comfortable chasing. And I would do it via calls, especially you highlight here. I think KRE is up 15% the last 2 weeks. It's been on fire. But if you go take that chart back 5 years and compare it to something like the Qs, massive underperformer. So if there's money plowing into this space that has underperformed, we think it's like a narrow hole for a lot of money to flow into, and there could be a decent amount of upside. And who's to say that KRE can't make new highs by year end, especially as earnings come in. We're getting most of the KRE earnings over the next few months. Perhaps M&A picks up. That could be a more next year story if Trump wins and the FTC it gets a little more comfortable with M&A, specifically on the regional bank side. And again, the earnings story is looking pretty good. We just saw great earnings out of the larger financials, and we'll see if that carries over to the smaller banks.
Yeah, look at today. JP Morgan up another 1.4%. Danny, real fast, like fast. You want to fade? You're looking through your notes. The sector you think is pretty weak is generally staples. Like fundamentally, so is today giving you a little gift with the bounce in staples?
I 100% think that this is, I'd be fading the bid to XLP. It's a rate today. It seems to be a rate trade and defensive trades getting long consumer staples. We think at Piper and talking to our eco teams, well, earnings will be troubled. why is inflation coming down? We know some of it's on the rent side, but a lot of it is on the good side. And this pricing power that consumer staples have had is diminishing. And that's why inflation is coming down. Inflation coming down, we think, is a negative for the consumer staples because their pricing power is diminishing, meaning margins are shrinking. And I think that will be reflected in earnings. Now, names like Walmart, they'll be fine. Amazon, fine. But Hershey's, General Mills, that's where you could see some struggles on the earnings front as margins are compressed, as pricing power is diminished. And again, today you're seeing a rally. Again, this seems to be more of a to some extent, perhaps a short cover, but a defensive sort of defensive play on a weak S&P. S&P down 1.3%. You have to put money somewhere. Staples are a winner today. I think when earnings start coming out, that won't be the case. And XLP implied volatility is dirt cheap. I think 3-month implied vol might have a single, might be 9. Like we're talking like de minimis, like the stock's at 78. I was looking today, the September 76 puts, I think, are 40 cents. Wow. It just is very cheap to fade these names. So yeah, I think like over the next 3 months, like why not? Like implied volatility is low. You'll get earnings. And these names, like, yeah, they could sit here. They could rally a bit. Don't see a ton of upside and could see a lot of risk on earnings.
All right, there's that XLP, pretty low vol there for sure. So it makes it cheap to try and take a bet. Danny, great stuff. Scares me how much we think alike sometimes. I wonder maybe like a long lost cousin or something.
Maybe I might have to stop following you on Twitter. I don't know.
All right, you man. Thanks for the trades. Always appreciate the specifics. So helpful. Appreciate that. Good stuff. Danny Kirsch, head of options at Piper Sandler.